Welcome to Macro Minds, where I talk to economists and other experts about the issues of our time. Welcome to Macro Minds, and it's my great pleasure to be joined by Gerard Lyons. I'm sure many of you are aware of Gerard. He's a veteran city economist. The Times described him as one of the most influential analysts on the global economy. He has 3 city roles. He's on the board and chairs the risk committee of the BGC and the Interdealer Brokers BGC. He's the senior independent director on the board of the Bank of China UK. He's a shareholder and strategist at the discretionary wealth manager Netwealth. Now, today, Gerard, thank you for coming. We're here to talk about China. Tell us, you go way back with China.
Well, first, it's great to be on the podcast. Thanks for asking me. Yes, I know China very well. Back in the old days, I was chief economist at Daiichi Kango Bank, who were then the biggest bank in the world. They were Japanese. I became an expert on Japan and Asia in particular. I first visited China in 1994 when the BA plane was landing. It was the only time where I was glad I had my seatbelt on, because it actually did a shuddering halt on the runway because someone literally was cycling across the runway as it was taxiing. That was real back in the old days. So I've been to China continuously since. I've spoken at the Party School. I've spoken at an EU-China summit in the Great Hall of the People. And particularly when I was head of global research at Standard Chartered, I visited China, indeed Asia a lot. Now, as you mentioned in the intro, I have a number of connections, but including that within that is on the board of Bank of China in the UK. So I go out to China on a frequent basis with them.
When was your most recent trip?
I went quite a few times at the end of last year, actually. Okay. Actually, of those, the one that was probably most interesting in terms of relevance for today's debate was the Friday after President Trump won the election. There was a big conference in China. There were 2 foreign speakers. Jeffrey Sachs was beamed in from the States, and I was the only non-Chinese person in the room.
Okay.
And the interesting thing is, on the main session at the very beginning where I was speaking, there were 2 very, very senior economic policymakers. And unlike here in the UK or the West, where people were thinking, gosh, was it good that Trump won? How did he win, etc. In China, it was really quite functional. President Trump has won. This is what we think he will do. This is how it will impact us. These are our policy options. Maybe we can talk through them, because one of the interesting things I find about the Chinese is that they are incredibly open. They discuss, they talk about what they can do, and then they tend to give forward guidance in a way in which central banks in the West probably wish they had stuck to, in the sense that the guidance the Chinese give is often what they end up doing. And I think it's particularly relevant in terms of how they've reacted to President Trump's tariff announcements, because the path of the process they've taken, in some respects, has been predictable. Obviously, we would have liked a different path to have been chosen, both by the Americans and in turn by the Chinese, because normally good economics is good politics. And the economics says that you don't put up tariffs, and the economics says that you don't retaliate with higher tariffs. But the politics tends to pull you in a different direction, as we've seen in the US and as we've seen with China's response.
That's right. And I'm hoping to just kind of get some key insights on the way China is thinking and the way it will approach the issue of tariffs. But could we just go a little further back before we have the tariffs? At the start of this year, what kind of shape is the Chinese economy in? And the 2 things I have in mind is, first, this kind of short-term cyclical issues, real estate imbalances, the aging population, but then the structural story, which is like, where is China in terms of the stage of economic development? Because this is a very big country. I think in our mind we think about the coastal regions, but there's huge western provinces with a very different economy. So could you give us a little overview?
Yeah, let's begin with the structural change. The Chinese economy is going through a significant pace of development. We've moved from double-digit continuous growth that was seen in the decades up to the pandemic to now where China's trend rate of growth is clearly slowing. Mm-hmm. And it's likely to continue to slow over the next quarter of a century at least. Not only that, but at the same time, the Chinese economy is becoming more difficult to run in the way in which it used to be run from the center. So that growth rate is potentially more volatile. So the Chinese economy is slowing and is likely to be more volatile. A decade ago, China kept talking about moving up the value curve and avoiding the middle income trap, and alongside that, boosting domestic consumption. The middle income trap is that it's easy, in theory, for a country to go from low income to middle income, but very difficult to go from middle income to high income. So to crack that challenge and move from middle to high income, it was recognized in China that they needed to boost domestic consumption. And they haven't really achieved that just yet. The saying in China used to be that you would be old before you were rich. People tend to save. The savings ratio is incredibly high. And there's challenges to get the domestic consumption rate up. The demographics too are changing, which is part of the reason why the trend rate of growth is set to slow in the future. So there are these big structural changes occurring in China. The pandemic also caused lots of social issues within China. But to put it in perspective in terms of the cycle, coming back to your question, last year the target rate of growth was 5%. China achieved that. Now, some people question the accuracy of the data, but generally speaking, the economy did pretty well last year without getting bogged down into the ins and outs of the data. 5% is equivalent to adding an economy the size of Poland to the global economy. And Poland is the 21st biggest economy in the world. Yeah. And the importance of China for us is seen in many different ways. But from a global perspective, over the decade up to the pandemic, China added a third of global growth. At the end of last year, the general expectation was that it was adding around a quarter of global growth, even despite the slower pace in China. And according to the IMF's forecasts at the beginning of this year, if one took a 5-year trend, China was adding a fifth of global growth. So China's importance to the global economy is very apparent. Well, that's the structural changes impacting China. But in terms of coming back to your question about the cyclical changes, at the end of last year, the Chinese economy, according to the Q4 GDP figures, grew by 5.4%. And the figures just out recently showed that in the first quarter of this year, GDP was 5.4% as well. And so both those figures were better than the markets expected, which suggested some resilience in the economy. Naturally, the figures in March might have been boosted by production being higher ahead of anticipated tariff increase. But the underlying worry, though, was that unemployment did pick up, particularly in the urban areas, picked up by 0.3% between the fourth quarter of last year and the first quarter of this year, up to about 5.3%. So the 31 biggest cities did see a pickup in unemployment. And one of the questions about the data accuracy last year was about the unemployment rate amongst graduates. So against that backdrop, and this was very evident in the two sessions in March, the Chinese authorities were not only focusing policy-wise about giving the economy a helping hand even before the tariffs, but they were also focusing on specific target groups.
So economies typically follow a kind of a natural development arc. China is, well, it still has catch-up potential, but it's moving away from heavy industry and investment towards more consumer and services oriented. And as you mentioned, that typically involves more business cycle volatility. The challenge for consumers, which, at least looking at the surveys, is they're chronically pessimistic with the real estate problems to 2019 onwards and then through COVID. But China is using various policy initiatives, from fiscal to central bank and then on the regulatory side. So give us a summary of actually what's going on in the guts of the economy. The real estate problems seem to be manageable. Consumer sentiment seems to be gradually ticking up a little. But we hear stories that China is still building too many factories, still investing too much in infrastructure. Is this really what's going on?
Yeah, there's a whole host of issues there. In terms of, let's take the property sector and debt generally, the natural rule of thumb amongst the policymakers used to be proactive fiscal policy. So whenever the economy had a blip in the past or a setback, fiscal policy was relaxed. That also occurred against the backdrop where the population was rising. The capital markets had not been fully developed. So if you were an individual in China and say you had some money, you might not naturally put it in the bank deposit because the interest rate was low. You might not naturally put it in the equity market because of governance issues. Some people might try and move their money out of the country, but generally that wasn't available. So the rule of thumb became the property sector. And so property developers would sell sites off book. People would naturally put up the deposit And it was always expected, like here, that it was a one-way bet up. The interest rate environment was quite conducive also to being able to sort of individually sort of borrow, even to put money into the property sector. And then suddenly a combination of factors. The macroeconomic environment changed. There seemed to be greater realization about the population dynamics. And suddenly that cycle that had boosted property suddenly started to go into reverse. And then that unearthed a number of practices that were not, shall we say, ideal. Now, importantly, in China in the last 2 years, there have been a couple of focuses. One on the fact that the property sector developments in China are seen as being very different to those in Japan, in that individuals did not leverage up the way they did before Japan had its property cycle change. But the second, at the same time, notwithstanding that, the realization that adjustments in the property sector can actually take a long time to fully feed through and impact the economy. So the policymakers have actually been proactive in terms of addressing that. It has led to Westerners, more so than people in China, talking about the debt issue. Because within China, I would argue that there's more relaxation about this, partly because government debt is much lower. Globally, public debt, and indeed globally private debt, has got to astronomically high levels. And that should be a concern globally, because in the last few decades, or particularly since the global financial crisis, globally we've relied on cheap money policies, which has led to lots of problems in the States, in Britain, and to a lesser extent on the continent. But in China, up until last year, it was very much a focus on prudent monetary policy and proactive fiscal policy. Now, over the last year, one would say that fiscal policy has become far more targeted. Even though central government debt is far lower, they're very cognizant of the debt problems in the two areas, the property sector and amongst local governments, because local governments in turn got heavily caught up in the property issues as well. So those are the two areas of the economy, property and local governments, where the debt problems are very apparent. What one has seen over the last year to give a helping hand to consumption has been targeted fiscal policies in terms of encouraging people to renew their old white goods and to take out new white goods. That's helping address the excesses that might exist in some parts of the corporate sector. Monetary policy of the last year officially became accommodative, shall we say. Last year, we saw 2 cuts in the reserve requirement ratio, which added probably about 2 trillion RMB to the economy. Policy rates came down twice last year by, roughly speaking, 0.3%. Also, in terms of monetary policy, credit is particularly important. In the central bank does actually lend to specific areas of the economy. So we've seen a far more nuanced, more targeted approach on the policy side in terms of fiscal policy not being used in the big bazooka way it was in the past, and monetary policy giving a helping hand. So there's coordination between monetary and fiscal policy. But coming back to your question on the property sector, I would say that the debt problems in the property sector and the challenges with local government investment vehicles, they're still working their way through the system.
So that just poses a challenge for the rebalancing, but the rebalancing is happening, which is natural. You can see these charts. It's a very standard story, actually. The share of manufacturing employment declines over time as your unit labor costs rise, the share of industrial, and then the share of services and consumption typically rises. So bring us to today. Okay, we have the news that the US announces significant tariff barriers across all its imports. This was anticipated by markets in spirit. Donald Trump is president. He's won for, his whole campaign that he would put tariffs up. They're focused principally on China. So at the moment, we have a 145% import tariff on Chinese imports into the US. China has reciprocated with a 125% import tariff, which amounts to a de facto trade embargo between the world's largest economies. China presumably has been surprised by the degree to which the US has raised tariffs. But you mentioned earlier the discussion in China is open. So how is China thinking about America's policy on trade towards China, towards the world? And what do policymakers expect the economic reaction to be, and what kind of policies are they thinking about initiating in order to try and counter some of the negative effects?
Before I directly answer your question, just as a prelude, because it's probably important background as well, one of the areas of debate in China at the moment is the deflationary issue. To what extent is China potentially vulnerable to deflation? It's become a central feature of policy, the intense competitive pressure in the corporate sector, which partly reflects the sort of excess capacity in one or two parts of the economy. So producer prices on their monthly basis have probably now fallen for 29 successive months. Consumer prices are effectively around zero. Core consumer price inflation, take out food and energy, is about 0.5. But so effectively, headline is 0.0, just above and below, depending on which month one's looking at. So China is on the verge of deflationary pressures. So they're cognizant.
Is it so much so you'd be worried about a liquidity trap, or
no, not necessarily, not there yet? But let's come back to that because it's important to put that on the table before we discuss about the impact of tariffs.
Fine.
So you've got the difficult, slower pace of growth in China. The two sessions in March very much focused on providing a helping hand to the economy this year. Target rate of growth of 5% this year. Budget deficit increasing from 3% last year to 4%. Monetary growth around 8%. So the central bank's still providing sufficient liquidity consistent with the economy growing at a far more moderate pace. Mm-hmm. Now, back in November, just after President Trump won at the conference I was speaking at, the two key policymakers who were speaking at that were very much outlining their planned agenda if President Trump did enact the policies that he was talking about. Now, in President Trump's first term, China was hit with tariffs. Now, the tariff hit in the first term was very targeted. Now, to put it in context, President Trump was reiterating the message, even though no one says this now. I don't agree with his tariff policy, but we should be cognizant back in 2005, 2006, the IMF convened for the first time ever a meeting of all the countries with big surpluses and deficits. America with the big deficit, Britain with the big deficit, but they came as part of the EU then. So the two deficit countries were America, Britain, and the four surplus countries were Germany, Saudi, Japan, and China. And the IMF then, and I would say here in the city as well, was fearful that if there was to be a crisis, it was going to be caused by the big imbalances. Mm-hmm. And the argument then was that the deficit countries needed to save more and the surplus countries needed to save less and spend more. And Chinese trade as a proportion of GDP actually peaked around that time, 2006. They again were very aware of the global influences as well as their domestic needs. And back in 2006, trade as a proportion of Chinese economy was about 2/3. Now it's down to 1/3. So trade in nominal terms obviously is much higher, but the dependence on trade and on the States as its big export market is far less than it used to be, but trade is still very important. So that fast forwards to where we are now, structural changes impacting cyclical changes as well. In terms of the first term, when they were hit by tariffs, the Chinese responded with a clunkily named dual circulation policy, foreign and domestic combining together. And they sought self-sufficiency in three areas: food, energy, technology. When President Biden won, he had a whole suite of executive orders which basically reversed President Trump's first-term policies in the domestic US economy. But he continued with the hard line towards China in terms of tariffs and sanctions in other areas, semiconductors, solar. Now, importantly, in the last year of the Biden administration, the channels opened up in terms of many different areas because there was worries, shall we say, both in China and in the States that the two sides were becoming too confrontational and there was not enough, so say, get outs. So we had there were quite a number of meetings between the Chinese and the US economic teams in the last year of the Biden administration. And we know that Janet Yellen, for instance, visited China, etc. But nonetheless, that confrontational era still continued. Now, the Trump tariffs hit much harder than people expected. But ahead of that, from November onwards, I would say that the Chinese focus was preparation in a number of areas. On the export side, it was about redirecting exports via third factories, reflecting very integrated supply chains, seeking out new export markets, not just on the Belt Road, but particularly ASEAN. For instance, back at the end of last year when the ASEAN summit was taking place, the Chinese premier visited. Just last week, Xi Jinping, the president, has visited Vietnam, Malaysia, Cambodia, a very successful trip. This last week, Indonesia ministers were in China as well. So China redirecting exports. In some respects, they did that in the first term of President Trump. Vietnam's exports to the US soared. And also at the same time, they recognized they might need to negotiate with President Trump in terms of if they had to open up areas of the Chinese economy, that they would be prepared to open up themselves and also become competitive. So that was the whole suite of things on the export front. On domestic policy, it was about the fact that they would need to continue with very targeted fiscal policy and, if necessary, move to unconventional monetary policy. And then superimposed on all of that, I would say, not that the Chinese necessarily use these terms, but my read of it would be that they might see this as an opportunity because global policy fora are undoubtedly going to change. And the scale of that change might become more significant given the degree of which President Trump is seeking the reset in trade and in defense. So there's opportunities for China, not just with the World Trade Organization in terms of trade, but with other global policy fora as well. So there are cyclical measures the Chinese can do or take. It's structural, but it also stretches into the non-economic as well as into the economic realm.
That's right, and that's a big difference this time around versus President Trump's first term. In trade tends to be quite sticky. It finds a way, in the targeted tariffs, which were to a much lower ultimate level in the first term for Trump, made it harder for US and China to trade. But if I look at merchandise trade for the US, imports excluding China and then Chinese imports, what you see is just trade diversion at play, which imposes costs. But in the end, you still get the stuff. The tariffs as they are prohibitively high, and looks like the US's stated objective is to just unlink the US and Chinese economies. But again, just trying to understand from China's side, two questions for me pop out. Actually, three. The first is, to what extent will China try to divert its production, its surplus production at home, which is creating some deflationary risks, towards other markets like Europe? The second is, to what extent would China see it in its advantage that America may be undermining global frameworks like the WTO? And then just China's broader Belt and Road Initiative. To what extent does this actually pose problems as the US and China are now looking to create their own spheres of influence on geopolitics and trade?
Yeah, a whole host of issues. Even ahead of the tariff announcements by President Trump, it was quite clear that some Chinese retailers were making big inroads. Here in the UK, for instance, there's 4.5 million parcels a week, so I'm told, from China that come into the UK. So the big pressure in the UK amongst retailers is the de minimis rate of tax being changed. So goods coming in under £135 do not get subject to any duties or levies. And the EU and the US have specifically targeted those cheaper imports from China. But there is always, if you have a dislocation in the trading system, then there naturally is a response. We've talked so far about policy level, but there's also the bottom up, companies themselves.
Yes.
The biggest Chinese maker of washing machines apparently produces 50 million washing machines a year. That supply chain is heavily interlinked. These supply chains, as we've seen with the recent announcements in the States reflecting Apple and the iPhone, 40 different countries or so involved in the production of that phone. Yeah. So supply chains are so interlinked. Now, companies themselves, if they're hit, are already on the production cycle. They might already have stock. So they naturally have to try and sell that. So there is always, in economic terms, a sort of dumping part of this process, which retailers in the West and others might try and guard against. But in terms of the redirection, one has already seen that, I would say, over the years in terms of China. China is becoming a lot more interlinked with countries outside of the West, namely across Southeast Asia in particular. But also, very importantly, coming back to your earlier question about structural change, China is trying to move up the value curve. So in the coastal areas, it's high quality production. That cheaper production has gone inland. So there is a number of factors coming together where the Chinese are naturally trying to change the nature of their economy. If we step back and look at it globally, made in China were the three most important words this century, and that helped keep inflation low and living standards up in the West after China joined the WTO in 2001. So we think global manufacturing, China is in the lead. Some might argue the reindustrialization policy of President Trump is a challenge to that, although it's not the case of the jobs coming back to the States because of automation and robotics. If we look at some other areas, AI and finance, AI is really the real driver from now on. And all the data, whether one uses Stanford, Australia, the global comparisons, two countries stand out, China and the US. Chinese universities are now taking the lead, it seems, in developing AI-linked research. From a British perspective, the good news is that we're in third or fourth place. But it's a gulf. It's like going from the Premier League to the National League. Never mind Championship or League One or League Two. But high energy costs in the UK will start to cause a big hurdle. Yeah. But you have China and the US in AI. But finance is also the fascinating area because America and Britain, to some extent, dominate in finance. Now, I'm involved with Bank of China here. The green agenda is very important in China. A green finance is particularly important. Bank of China, for instance, has signed an MOU with the UK government last year. Don't want to give a plug, but I'm just highlighting some of these significant shifts. Now, President Trump putting away from the green agenda provides an opportunity in London, but there needs to be a lot more green assets for funds to put their money into. But the finance space that's really up for grabs, maybe, or an area that we should focus on, probably rather than saying up for grabs, is the digital currency space. And last year, the Chinese moved to the next stage of the M-Bridge system, which is developing the digital currency. Now, the Bank for International Settlements is involved with 5 central banks, PBOC, People's Bank of China, Hong Kong Monetary Authority, Bank of Thailand, UAE, and Saudi Arabia joined it last year. And you have about 15 or 20 other central banks observers. So in terms of these moving parts, manufacturing, clearly, we're seeing significant shift, having to move up the value curve. And it's not, if you just do it on cost, someone somewhere else will always do it cheaper than you. So it's about making manufacturing more competitive, but on quality as well as cost. Then we've got the big change in terms of the AI space, and we have a big change in terms of the financial system that is yet to come.
And does that involve an ambition to challenge the US dollar as the single reserve currency and get the yuan a little bit further up the league of reserve currencies that gets used for transactions? I mean, it's a tail risk, but it's a tail risk that market commentators, economists, analysts are asking more often now, which is to what extent does US trade policy undermine the dollar's role? And the thing that I've been pointing out is we have to distinguish between using a currency and holding a currency.
Yeah,
we hold a lot of dollars and we use a lot of dollars, but we don't need to hold the dollars, but we can use them, and it's the using them that gives the reserve currency status rather than the holding. And so there's an interesting development that's playing out. We see it in sterling, we see it in yen and euro. These appreciations are basically a shift in the holding patterns of currencies, but nothing to do with the changes in reserve status.
Let's put that in the context of globalization or deglobalization, because we're now moving from globalization to fragmentation, from free trade, which was an integral part of globalization, to protectionism. And globalization is not only changing because of economics, it's also changing because of geopolitics. And that puts geopolitics and national security alongside economic prosperity in terms of policies in the West. And globalization has changed in the wake of the global financial crisis. In Western economies, and we see this with President Trump, there's been great awareness of the losers from globalization. But also across emerging economies in the wake of 2008, it was referred to as a Western financial crisis, not a global financial crisis. But many emerging economies became wary of opening their capital markets too much for fear of being vulnerable to large inflows and outflows of capital. And on top of those economic changes, we've seen political changes in terms of geopolitical. So globalization is under threat. And what one is now seeing with President Trump is that international investors are questioning the safe haven status of the dollar. The question then is where you go to. And but answering your question, one needs to differentiate between the cyclical and the structural.
That's exactly right.
Cyclically, the PBOC, the central bank, is quite clear. They have a monetary policy review each quarter, and they produced the English version a little bit later, not too late. But the quote from the last one, which is a consistent one, is, in terms of the RMB, the currency, it's about keeping it stable and, quote, upholding the decisive role of the market in the formation of the exchange rate. So they recognize, and you see this in many aspects of policy in China, the recognition that the private sector has a vital role to play. So when it comes to the cyclical aspect, the focus is on relative stability of the RMB. The big worry for many Asian economies at the moment would not only be a direct hit from the US if the tariff issue is not resolved, but also the indirect hit if the RMB was to weaken, say. But in terms of structural terms, there has been an ongoing desire to see greater use of the RMB, but it's still so far down the scale. But use of it has started to rise significantly. Hong Kong, as an offshore centre of the RMB, has started to put the whole infrastructure in place. We're starting to see clearing banks for RMB overseas, and we're starting to see all the financial infrastructure in place were it to be the case that investors and individuals wanted to hold the RMB more. Obviously, China doesn't have capital account convertibility.
That's right. Yeah.
And that's the next big step.
Yeah. To move to a floating exchange rate is very difficult,
incremental change at the moment, but in a clear direction.
So two final questions from me. Again, from the Chinese side, and I would just say for any of our listeners, we had Mickey Levy on our previous episode discussing all of this from the US side. So these two episodes provide nice counterparts. From China's perspective, what do they hope to achieve in likely upcoming negotiations with the US on trade? What's an acceptable price to pay for lower trade barriers, and what are the kind of things that they might expect to trade off in exchange for lower trade barriers, or given the trade diversion away from the US and the ability to pull levers to stimulate domestic demand if necessary, is China likely to pursue a policy where they say to the US, look, it's for you guys to just backtrack on your policies, otherwise we're not ready to negotiate?
Yeah, impossible questions to answer in some respects. But one needs to
But there's a great
be
deal of
mindful
self-esteem on both sides at the moment in play. This is beyond just pure economic policy.
Face becomes an important issue in this. I think, therefore, it's important for these back channels to create the opportunity. From a US perspective, the Treasury Secretary has talked about diffusing the situation. The markets are sending a clear signal that current levels of tariffs are not sustainable. If we have these levels of tariffs continuing, then we're talking about going to a decoupled global financial system. And if you have a decoupled trade, let's be clear, it suggests a decoupled trading system, which might be a prelude to a decoupled system in other areas. But it's hard to imagine, given the complexity of supply chains, that is the natural step. So I would hope and expect to see some diffusion of the current situation. But just as in the first term, the imposition of targeted tariffs led China on a certain path to go for self-sufficiency in certain areas, one has to be, again, mindful of controlling the controllables. The message within China, clearly, the way I would read it, is that you need to have sensible macroeconomic policies, and you need to continue to change the structure of your economy to move up the value curve. The Belt Road Initiative itself is very important in terms of Chinese ties with other countries. Foreign direct investment flows from China this year have been into places like the Kingdom of Saudi Arabia, to Pakistan, the Stans. So these are sort of helping China's structural change, but also being well received in the domestic economies. If one looks at it from a geopolitical perspective, which has really come into the fore, we have a G3 world at the moment. Group 1 is America and its allies. Group 2 is China and its partners. Group 3 are the middle ground powers. India, Brazil, Nigeria, countries who are becoming more important in how they influence the global debate, but they are not necessarily aligned with America or China. By coming back to your question, all these changing parts in the geopolitics will be handled in a certain way, but I think the key message in China is to have a more stable domestic macroeconomic picture and to try and move more up the value curve. And that includes deepening and broadening your capital markets, particularly the bond markets, and also to move to greater transparency and better governance in certain areas.
And so, final question. We've covered a lot, but what's the one thing that we've missed out that you think is relevant for markets and analysts to be keeping in mind?
Well, look at what was talked about in the 2 sessions in March, even ahead of the scale of the tariff change. Guarding against global shocks and diffusing risks was a central feature of the Premier's speech. We now have the move to the next 5-year plan, which is spring of next year. In China, I always used to think people talked about 2 years, 2021 and 2049. So 2021 was the 100th anniversary of the party, and 2049, the 100th anniversary of the founding of the state. So the Chinese still have clear targets about where they would want to be at certain periods of time. But where does one leave it? I think it comes back to macroeconomic stability becomes center stage this year. Taiwan is an issue that people mention in the West often, but we've had a reset from President Trump in terms of domestic policy on energy and migration. We're now seeing a reset from him in terms of defense and tariffs and trade. Another reset people used to talk about in the States was land in terms of some things he said. But the Chinese, I'm not going to double guess what will happen in terms of Taiwan, but I think the Chinese will be mindful of these global issues. And what one also saw in March was a desire at the 2 sessions to actually become more integrated with Taiwan through economic measures. I used to visit Taiwan quite frequently with Standard Chartered. The KMT and the DP, the 2 main political parties, one is a lot more domestically focused, one is a lot more integrated with economic ties with the mainland. So the point being is the Chinese are mindful of not only where they want to go, they're mindful of international pressures. And they will seek, I think, to try and deepen their ties with Taiwan through economic means. Excellent. And hope that the domestic situation changes in their favour. But that's the thing that people often ask me about in the West. But I think it's an impossible one to predict. But I think the important thing is when you speak to Chinese policymakers on the economic front, they come across quite well. And so one hopes that the economic levers that are pulled will be sensible.
Excellent. Well, Gerard, that's been an education. Thank you so much. You know, we're always guessing from afar what may or may not be happening in the second biggest economy in the world. So that's been extremely insightful from my perspective. So that leaves us with one thing. Where can people find you if they're interested in hearing more?
Okay, thank you. Actually, I should give a plug to a podcast I do with my eldest daughter called Elf-onomics, ELF-onomics. She's a stand-up comedian. She's currently on her 3-month tour of Australia, so we start the weekly podcast again when she returns. But why is coffee so expensive and things like this?
I've had a listen. It's great. It's worth listening to.
Or you can contact me at Netwealth, or I write stuff for CapEx with the Centre for Policy Studies hat on. But you could always email me at gerard@netwealth.com. So GERARD @netwealth.com.
Thank you so much.